Hey, what's up, YouTube? Welcome to Super Stock Bros. My name is Ace, and today we're going to be talking about our portfolio, this crazy market, and what's going on with these market mechanics, and should you be worried for the long term? Stay tuned. Okay, so first things first, the painful part of where is our portfolio at, and did I suffer as much as you guys did? And the answer is yes. So, taking a look at our swing bullet, nothing has changed here. We're still sticking with the strategy. I do not have this bankroll anymore. You'll see as we go to the portfolios section, but that's okay. We're looking to make that up, and we're sticking with the strategy. We're not pulling out of the market or anything. So we're going to keep this rolling, especially because our SPAC play depends on Chamath announcements. It doesn't really matter too much about the market dynamics, although obviously that does have a factor with supply and demand. But you know what? Let's leave that for a second. So the SPAC swing bullet took a hit after that CCIV trade. Unfortunately, I'll show you that in a second. And the other account is actually still quite healthy because we don't jump around with it so much. So you know, if you tend to jump around a lot, you're probably going to lose money in the long run, quite frankly. So swinging is usually a bad idea, but I was doing it for fun. Now, our portfolio. So IPOF did take a hit. It's actually just about where we bought it the first time around, so 443, and we're only losing about $40 on this portfolio. So this SPAC Road to a Milli challenge is actually quite okay. It's not healthy, but it's quite okay. So we'll leave that be for now. The swing portfolio. So I was not joking when I said I bought all of those CCIV warrants. I took a hit, and because I want this to be a swing portfolio, normally I would keep these long and just hold them until CCIV got to production and all this stuff. But now this is a long-term trade, and I do not want it in the swing portfolio. So I did unfortunately sell out. I just said I moved it. I do actually still have the shares and some of the warrants, but I'm not going to include it in the swing portfolio. I'm just going to pretend like I took the loss, and that's going to bang us down pretty hard. Technically, this is close to where the market prices are at, but I put it to when I took the loss there. We did add 2,000 IPOF warrants at around 473. Remember, I said I would buy them at 5, and then I bought it again at 450. So my average was about 473. I might actually add more onto this. We'll see. But all of my positions are kind of locked up right now because of the overall market dynamics, unfortunately. And that's what I wanted to talk about next. So we'll make this back. I'm pretty confident in it. I'm not too worried. And again, the SPAC Road to a Milli challenge is still in full swing. This was more for fun anyway, so that's okay. Don't worry about that. In terms of market dynamics, I got to preface this by saying I'm not an economics expert by any means or anything like this, but a lot of people were asking me in the Discord, hey, what's going on? Should I be worried? And all of this stuff. I wanted to go over the basic market dynamics and what we're working with here. Maybe bring some logic into this crazy world of pure red. As you can see, everything is basically down. I don't even think I have any pick up right now. It's pretty wild, and these are mostly spec picks that I wasn't even invested in the first place. JV's up though, hey, but beyond that, yeah, everything is down, and there's a good reason for that. And perhaps we should have seen it coming, and this is why it's a good idea to watch for the macro trends. But regardless, like I said before, constantly swinging in and out is not a good idea, not only from a tax perspective, but also because it's going to lead you to make some bad decisions in the future because you shouldn't be thinking so short term. Anyway, let's talk about what these market mechanics are and possibly looking forward into the future to see if we can make a healthy comeback. First things first, we need to talk about bonds versus interest rates. Now, this is a very important concept because you have to know where money is going. That's what the economy is all about. Is it in the stock market? Is it in bonds? Is it in real estate? Where is all that money? And obviously, it's hard to generalize across all of the sectors, especially because smart people diversify anyway, right? So, but this is the general trend for the big whale movement. People with billions of dollars, trillions of dollars are moving constantly because they want to go to the low risk areas, right? So what happens, for example, when bond yields rise? And this is what's happening right now. I'll show you a quick graph of this is pretty wild. What's been happening for the past month. As you can see, In the past month, this is crazy. We've gone from basically 1 to 1.5% in the bond yield. This is wild. Just to show you how wild this is, during the pandemic, for instance, we did see something like this where it quickly went from 0.5 all the way up to 1.1, and I mean that's comparable, right? And that was when everybody was incredibly worried, and the economy was basically just stopping to like a dead halt. So to see a move like this, 0.5 in just a month, that's wild. That is kind of crazy. And that's why you're seeing such a violent reaction in the stock market. So, and you might be thinking, okay, what does this even mean? Who cares about bond yields? Okay, well, let's go back to our market mechanics here. Okay, so why is it important to understand about bond yields? Well, here's the thing. Bond yields and bond prices are strongly correlated with stock prices. And I'll show you why. There's a good explanation here. Here's a wall of text for you. Bond prices and stocks are generally correlated to one another. When bond prices begin to fall, stocks will eventually follow suit and head down as well. Why is that? Well, as borrowing becomes more expensive, okay, here's the interesting point, and the cost of doing business rises due to inflation. Another key point, because inflation is actually rising steadily right now. If you look at copper prices, etc., things are getting a little wild. It is reasonable to assume that companies, stocks, will not do as well. Okay, so stock prices are falling. Now, it's not reasonable to predict that the entire market would crash or that we would see such a heavy reaction, but it does make sense that we're seeing this for multiple days as a pattern. Okay, so I wrote this in here. So as rates rise, mortgage rates rise. In other words, you have to pay more for your mortgage. Okay, so you have more mortgage expenses. What does that mean? Your cost of doing business goes up, even if it's personal, right? Your personal cost of business goes up. Then you have less money for stocks. Okay, that means stocks will perform less well. Now, the same logic applies to actual companies because, hey, they're paying more for copper, they're paying more for semiconductor chips, for example. So if you have something like this happening, stocks will on average perform less, or they'll be less valuable because they're paying more to get a higher return. What about stocks? If the interest rate rises, bond yields will rise and prices of bonds go down, and so do stocks. Okay, so the interest rate rises, bond yields rise, the stocks will fall, and so will the bond prices. Okay, you don't even have to worry about bond prices. Just think of the stocks here. And on the other side, if interest rates fall, which last year we saw that, we had the interest rate pinned down at a low level, and the Fed kept telling us that it would stay low, then bond prices go up and stock prices go up, and the yields go down. And indeed, we saw that last year. All right, so if we look back 1 year, back in around March. So as you can see, the bond yields fell, okay, and then they spiked up a little bit because of the panic, and then they fell back down. This is when the stocks were picking up, okay? And now you're slowly seeing the inverse. It's coming back up. It regulated, came back up to the norm here, and now you're seeing a sudden rise, okay? So when this happens, you're going to see a violent reaction in the market. Okay, so what is the summary of our market mechanics here? As the economy gets healthier, now this is the main reason people are saying bond yields are going up. As the economy gets healthier, bond yields and mortgage rates will price that in. So they're pricing it in ahead of time. And, you have to pay more for your mortgage, and et cetera, because these rates are kicking in. And they assume that you have the money to do it because the economy is healthier, so you're probably making more money. And what does that mean? That means that bond prices and stocks will fall, because I showed that earlier. The direct relationship between interest rates and mortgage rates and bond yields is that they're inverse to the bond prices and stocks. Okay, so as yields and rates go up, bond prices and stocks fall. Okay, so what's next? Why do you have to care about all these market mechanics and everything like that? Well, it's important to understand because as stock prices fall, now you're going to see the relationship flipping, right? Investors will be more interested in stock prices because now they saw the highs and they want to get back in at the low, basically, and try to get that 20% gain on like Square or whatever, right? For instance. Now, that is important to know because that means that eventually this will end. It's not like the market is crashing. Don't worry about it. Although, as you see the bond yields keep rising, the stocks will fall, as we've shown. So that might happen. And actually, the bond yields are still rising even as at the recording of this video. It's kind of crazy. But just tough it out. Eventually, things will level out again. Okay. When? My guess personally is April, though these market mechanics have been flowing pretty quickly for the last entire year. Like, I didn't think that the market would recover for another 2 years, let alone within the same year. And then after that, the bond yields rose within the same year after that. So things are moving at a very rapid pace. This was an unprecedented thing for the stock market. And that's why you're seeing these market mechanics move so quickly. And it's just so easy for money to flow around nowadays. So that's important to know. So I would say that it can recover as quickly as 2 weeks or a month. Worst case scenario is probably April. Okay, so tough it out. It's important to know the correlation between the three biggies, right? The bonds, which is very, very low risk. It's basically risk-free for like the trillionaires. The interest rates as it relates to like mortgages, especially mortgage rates. And that is like considered risky, but not as risky as stocks, for example, because you have collateral, the house, if the other person were to go bankrupt, for example. And then thirdly, you have the stocks, which is the riskiest of all the three. And that one is affected the most when bonds go up. And I hope that taught you something. Look more into it. I'm going to post some links in the description so that you can check it out yourself. This is really the summary. You want to just wait, 2 weeks to 2 months, and everything will recover probably back to its previous highs. So just wait it out. That's what I'm going to do too. I'm right there with you. I'm feeling the pain, and it might take some while, but eventually we'll make those gains.